Investing into a global ETF is one of the most passive approaches you can take with investing, but which one is the best? I've compared Invesco's FTSE All-World Fund to the Vanguard equivalent in a previous video, with new investors generally preferring Invesco's offering due to its lower fee. Now we're going to compare the Invesco Fund to an ETF with an even lower fee, the SPDR MSCI All-Country World Fund from State Street, with the ticker symbol ACWI. The main difference with this comparison versus the last comparison is that both the Vanguard ETF and the Invesco ETF both track the FTSE All-World Index, whereas the SPDR fund tracks the MSCI All-Country World Index. There are a few intricate differences in how these ETFs track their index, but the main difference between these two funds is the index itself. Both of these indexes cover both developed and emerging markets, but the FTSE All-World Fund covers slightly more of the global market, around 90% of the investable global market, whereas the MSCI ACWI fund covers around 85%. This can be seen in the number of holdings that each index has, with the FTSE All-World Index having around 4,228 holdings. Compare that to the MSCI ACWI Index, which has around 2,558 holdings. This difference also leads to a different concentration in the countries that each index covers, with the MSCI Index having a smaller number of holdings. It also means there's a slightly higher concentration in certain countries, for example, the biggest one being the USA. This has then also led to a slight difference in performance, which you can see from this graph here. This looks at the performance over the last 20 years, and as you can see, it's fairly similar up until about 2014 when the lines start to diverge. And this is largely down to that different concentration in those countries, specifically the USA. We've seen over the past decade that the technology stocks, specifically the Magnificent Seven, have well outperformed the rest of the market. And that's when you can start to see these lines start to move away from each other. You can see that, for example, if you compare the S&P 500 to the global market. Of course, just because the MSCI index has outperformed the FTSE index over the past 10 years doesn't mean that's always going to continue. So your first decision point when choosing between these two ETFs is, do you want slightly more exposure to the USA? And let me be straight, we're not talking about massive differences here. The Invesco fund, covering the FTSE All-World Index, has about 60.09% in the USA. Compare that to the State Street MSCI fund, which has about 61.49% in the USA. Now onto the ETFs themselves. And with the FTSE All-World Index being much larger than the MSCI ACWI Index, you may expect that the Invesco fund has a lot more holdings, but in fact it actually only has just under 200 more, with the Invesco fund having around 2,399 holdings compared to the SPDR fund, which has around 2,205 holdings. So as you can see, the State Street fund has a much higher percentage of its holdings covering the index. So in theory, there should be a slightly smaller tracking error because it's covering more of its index. I mentioned in the previous video where I compared the Invesco fund to the Vanguard fund that the Vanguard fund holds a lot more holdings in its ETF. And I put that largely down to the Invesco fund being fairly new. It was only launched in June 2023, so it's just over 2 years old now. And as it starts to build up in size, I imagine these number of holdings will increase. As you can imagine, with an index so big, it can be so expensive to cover a large percentage of that index. So in order to keep the fee down, it does a sampling approach where it can still get most of the exposure to the index, but without having to cover all of the index. But I do expect that to slowly increase over time. In terms of fees, these ETFs are very closely matched. Now, this was a big point in the last video where I compared the Invesco fund to the Vanguard fund. That Vanguard fund has an ongoing charge of 0.22%. Compare that to the Invesco fund, which has an ongoing charge of 0.15%. This was a big decision maker for new investors coming into this space because although it's only 7 basis points between those two funds, over a long period of time, that can start to make a difference in your portfolio. But the difference between these two funds is only 3 basis points. The State Street fund is actually cheaper than the Invesco fund at 0.12% ongoing charge. And another fee that doesn't always get enough attention is the spread of that fund. And this can vary throughout the day depending on the supply and demand and the liquidity of the fund. And I mentioned in the previous video that because the Vanguard fund was so much bigger, it tended to have a tighter spread because there was generally more liquidity in the fund. And because the Invesco fund is a slightly newer fund, it has a smaller AUM compared to both the Vanguard fund and the State Street fund. It's still a massive fund, but when we're comparing the liquidity, it will have slightly less liquidity, which sometimes means there will be slightly wider spreads depending on when you trade it throughout the day. At the time of recording, I found the spread of the Invesco fund on the Hargreaves Lansdown website around 0.12%. Compare that to the State Street fund, I found the spread around 0.03%. And that's largely down to the State Street fund being bigger in size, around 3 times as big in terms of AUM. But the Invesco fund will grow over time and its liquidity will improve. The AUM is always increasing. Remember, it's only 2 years old. So over time, that won't be as much of an issue. It's just a bit of a difference right now. In terms of the best time of day to trade for liquidity, generally it's going to be in the afternoon UK time, around 2 to 4 p.m. That's because both the European markets and the US markets are going to be open at the same time, and that's when you may expect there to be the most liquidity. That's not always going to be the case, but just generally looking back on historical data. So there's really not a lot to choose between these two ETFs. The State Street Fund is a larger fund. It's been around for a lot longer. It's going to have more liquidity and a tighter spread, and it also has a lower ongoing charge. But it also doesn't cover as much of the global market than the Invesco fund. For me, because the fees are so close together, I wouldn't put too much attention on the actual costs of these funds. It's only 3 basis points in terms of the ongoing charge. It's not like the 7 basis points comparing the Invesco fund to the Vanguard fund. And it then comes down to your preference of which index do you want to cover. Do you want slightly more of the global market with the Invesco FTSE All World Fund? Or do you want slightly higher concentration, still covering a large amount of the global market with the MSCI ACWI fund? In all honesty, you can't really go wrong with either of these two ETFs. They both cover the global market. They're very passive and very hands-off. You're not picking a particular sector or region. You can just sit back and invest for the long term. And like anything with investing, the main thing comes down to how much money you can put into the fund, how consistent can you be, and making sure you have a long-term approach and not going to panic when there is a market downturn, making sure you're investing for that long period of time. I'd be interested to hear your thoughts. Are you State Street, Invesco, Vanguard, or maybe there's another fund that I haven't covered? Let me know in the comments down below. A big component in investing for the long term is making sure you've got a tax-efficient approach. So watch this video next where I show you how you can maximize your ISA growth. Thanks for watching, guys, and I'll catch you in the next one.